Welcome to Crash Concepts, where the economy, energy, and the environment are explored. Up next, fresh ideas and insights into the factors that are driving the world and shaping your future. Presenting information you can't afford to live without, here's Chris Martenson.
Welcome, everyone, to this Peak Prosperity Podcast. I'm your host, Chris Martenson, and it is November 5th, 2018, Guy Fawkes Day. Hey, today we're going to be discussing these volatile financial markets and what we might make of them. Will the volatility continue? Will it increase? Will it decrease? Do we have enough information to say that the central bank's removal of fresh new liquidity from the global punch bowl means that the party's over? Returning with us today to discuss the economy and markets is one of my favorite guests, Steen Jakobsen, the Chief Investment Officer and Chief Economist of Saxo Bank. He has many years of experience within the fields of proprietary trading and alternative investment. He travels widely, reads and writes constantly, and thinks very broadly and creatively about the world and where it's headed. Steen, it is a real pleasure to have you back with us today.
Thank you for having me, Chris, as always.
Well, Steen, equity markets, once again, I'm going to call them interesting and displaying volatility that some young traders might not even recognize. What do you make of this recent volatility? Is it just normal hiccups or the start of something more?
I think it's more the end of something. I think what we, and I certainly being one of them, mistakenly when we looked into 2018, we ignored this great wall of repatriation out of the European deposit from U.S. corporation into the U.S. And of course, at the run rate we have right now in terms of buybacks in the U.S., we will exceed $1 trillion of reduction of float in the U.S. stock market itself, which of course has carried this anomaly all the way through, even into the narrative of commentators on the markets that the stock market has only been going down for 3 weeks. Chris, as someone who travels the rest of the world has been going down all of this year. Mm-hmm. So I think what is really happening is that we have a recoupling of the U.S. stock market to the rest of the world. And blended into that, of course, a huge disappointment of some of the marquee names like Apple, Facebook, and the likes that has been early leaders. But certainly to me, this is almost entirely about the fact that the U.S. stock market was kept artificially alive, and in the process probably also made Fed do a policy mistakes in terms of keeping the hawkish trajectory in place too long.
Yeah, so, Steen, I'm seeing a really confusing set of indicators here. Some are solidly risk off, some still seem to be risk on. For instance, I don't see treasuries really moving in the way I would expect in terms of them really gaining in price, dropping in yield as this volatility in equities increases. So that's just one of many confusing indicators I see. As you look across the landscape, what are you looking at, and do you see similarly confusing indicators at this point?
I guess I'm a little bit more primitive than you, Chris. So I operate in a world of primitivity, and I like to make things simple. So we have right now a macro theme called the Four Horsemen, mm-hmm. and this is not like the Bible thing. It's just there are four drivers of the global economy. And if you allow me, I'll go through those four. And they would be the quantity of money, which is falling, the price of money, which is rising, which is part of what you just said, the price of energy, which is rising, which is a tax on consumers. And then you add the more sort of soft value of globalization / productivity, which is also falling. So if you look at that sort of way of approaching the economy, and this is back to what I told your listener about last year, I really don't know what happened in the black box, but I can observe what goes into the black box. And these are the four things that goes into the black box: globalization, quantity of money, price of energy. And let me take you individually through all of them. So globalization, productivity, we know that's all about Trump, trade war, and the likes. It's not exactly improving, it's actually worsening. The quantity of money, a lot of people argue with me that, the central banks are still expanding the balance sheet. But, the fact of the matter is the QT in terms of the U.S., of course, has been reducing the stock in the Federal Reserve balance sheet. And we have stealth reduction of outstanding balance sheet in terms of the Bank of Japan. ECB would love to cut it. Bank of England, already indicating and doing the first hike. So, the quantity of money falling, the credit impulse, which we have talked about at length, turned around over the course of the last 3 to 4 months, entirely based on China, again, expanding fiscal and monetary policy. the price of money, the pricing, the Fed trajectory. I think what the mistake, again, I made, and I make a lot of mistakes, was that I think Powell is really in the mold of Volcker. He's a practical guy. And what he's decided to do is pretty much just to hike interest rate until the market collapse. So in other words, I will indicate, Chris, that the stock market impact or the Fed pulsing from this tightness is probably 5 to 10% below the recent low that we saw in the stock market. If we don't get to that level again, he's going to continue to hiking. So you almost have a self-feeding process by which ultimately the stock market will have to collapse, because the behind-the-scene pragmatic way that Powell does his policy really means that interest rate going up, and hence you haven't seen your safety move to safety in terms of Treasury. And then the final one, which is probably often ignored, the price of energy. I mean, one thing is that price of energy is up at 15 to 20% in terms of the oil price input. But if you add to the fallout from the emerging market sell-off and the currency negative impact, you will have prices on petrol in energy-intensive countries like India, Indonesia, China, where the prices are up somewhere between 50 and 100%. Imagine how much of the purse that actually energy takes away from these developing economies in terms of the purchasing power. So I think what we're sitting in the middle of, Chris, is finally sort of all of these four engines, or the lack of the four engines supporting the world economy, is now coming into the real economy after we have had the tailwind, the tailwind of tax cut and repatriation of capital. So even the U.S. now is seen to be swimming naked.
I really like this view, and it just kicked off about 600 questions in my mind. Let me so many things you touched on. Steen, first, you mentioned a stealth balance sheet reduction by the Bank of Japan. Explain that. What did you mean by that?
Yeah, so we know there's a fixed number of yen that the Bank of Japan would and have suggested they will intervene, and they have done significantly less than that, or mostly 2/3 of that. And now they're even allowing the YCC, the yield curve control. So in Japan, unlike in the U.S., they are really trying only to steer monetary policy through the 10 years interest rate being fixed, and the fix should be between 0 and 10 basis points. As we talk, it's trading 11, 13, 14. So actually, the Bank of Japan has allowed the rates to go beyond the border, or the roof in this case, that they have indicated. And they have done that through less intervention than they announced. And part of that is actually the inflation pickup has been significantly higher. And we've seen the corporate structure in Japan also delivering better earnings results. So basically a function of policy, but also a stealth action, because they actually done less than you would have put into your budget if you were looking for the amount of yen that would have been printed in the year 2018 from Bank of Japan.
So this is the overall theme, which I've been trumpeting as being really important, is this quantity of money. If I told people, listen, there's just one chart you need to look at, it's just take the collective actions of the major central banks in terms of their additions or reductions in their balance sheets, which is the quantity of money out there. And we are as yet on track, I guess, for 2018, maybe early 2019, for that to actually dip below zero. Is that what you're seeing? And do you think we'll get there, and will that continue?
I'm actually at negative already. So we have a model, which, if we can provide some chart to your listeners, we can provide you. We have a liquidity by major central bank. It's negative 1% of GDP right now.
Really?
And what's interesting, Chris, is that this is below what we saw in 10, 11. It's certainly below what we saw in 8 and 9. And it's even below what the recent low we saw with the fallout in China in 15. So, of course, the major stimulus plus minus in this remains China. But China contracted. I think I made it a big focal point of our last conversation a year ago about China slowing down. And now it's happening. So the global monetary, if you look at M2, and let me just briefly explain why this is important to your point. So the way we have created growth in the world since the great financial crisis has been the following. You have a fraction. On the top of the fraction, you have the credit creation. That has generally been in the neighborhood of 6 to 10%. Below it, you have the world growth, which is 5 to 6. So, from 2010, 2008 onwards, we've had a positive fraction bigger than 1, 1.5, 2 even. Right now, what we see is a global growth, as per your number, and the confusion is +2 against the 6% growth. So we have a 1/3 of it. But the global contraction in terms of the flow of that flow is now -1% of GDP. In other words, the very method by which we expanded the growth factor in the world through issuing more debt has now gone into a negative, and hence you see both fixed income and equity markets to some extent sailing off. And certainly you see the countries with higher fiscal and current account deficit having to pay the price because the marginal credit cake, the size of the credit cake is smaller. And not only is the cake smaller, you pay more for a piece of cake than you did before in terms of the price of money.
Now, Steen, I hope you can explain something for me, and I hope some of my listeners find this useful, but I've never understood how it's equivalent looking at what the ECB balance sheet's doing versus what China's up to, mostly because I understand how the ECB money flows into the capital markets. China doesn't feel quite as open on a capital market basis. How are they equivalent? So is China's easing the same as the ECB's easing? How would I begin to make sense of that?
Yeah, so first of all, from a statistical point of view, it is very difficult to monitor these credit flows. So creating the credit cake that I just alluded to is, in China's case, you need 6 to 8 different indicators to create that number, where in the case of the US is 3, in the case of Europe is actually 2. So it's far more complicated because you need to include the shadow economy, the SOE banking sector, the credit facilitation announced by the PBOC. But relatively speaking, you can do that. And it does work the same way, but in a much different way at the same time, in the sense that, so the policy by the PBOC, the Chinese central bank right now, is to take a huge chunk of the shadow economy, the one which is not done directly through state-owned enterprise banks and liquid banks, but through peer-to-peer and other lending scheme, and put it onto the balance sheet of the SOE-owned banks. The way they do that is by reducing the RRR, the reserve requirement ratio. The reserve requirement ratio is, generally, if you did it in a U.S. bank, you would see this as an increase in the multiplier. But in the case of of China, it is really a story of moving as much capital lending from the shadow economy onto SOE by giving them more and bigger balance sheets. So the difference is you have a far more managed process where a traditional reserve requirement decrease in the case of the U.S. would mean more leverage. It doesn't necessarily mean that in China. And I think that is often the difficulties I have with reading English U.S.-based research on China. Everyone assumes they are like for likes. But in the case of China, you have a system with far more active players for every level of policy that you're trying to enforce.
Yeah, and that, I think, thank you for going through that, because that's been my confusion. They didn't seem apples to apples, so I was never quite clear on how to put them all into one chart. But that really helps a lot as we look through that. So we've been through the first horseman, quantity of money that's falling right now, minus 1% of GDP. That seems like a big deal to me. It's been, how long has it been since we've seen that? I think it was, as you mentioned, we have to go back to one part of 2015
when we had the scare, the devaluation in China, and then in 11 during the European banking crisis, and then 8 and 9. But what is significant is it is lower than at those times. But what I also want to bring in is that we in Europe talk a lot about the Brexit and the lack of consequences in the economy. Do you know which credit cake is shrinking the most in the world right now? The UK one. So it's interesting as the solution in terms of Brexit remains elusive. The actual underlying economy is now having to pay the full price of the inaction, lack of traction, lack of transparency, lack of credit creation. So that is the constant theme I'm trying to get to here. I have no idea about the future, Chris, but I can observe what goes into the economy. And in case of the UK economy and the world economy, there is less credit, the very credit which has been 80% of all the dues for all of the action we've seen since 2029 and the low in the stock market.
Yeah, that 80% of the juice. So this is one of my main critiques when I'm really, wagging my finger at the central banks. I start with the Federal Reserve. I start with Alan Greenspan and his, I think, super ill-advised attempt to replace the business cycle with the credit cycle. So we're now on our third major attempt to see if you can steer macro policy with credit cycles. I just see them as boom bust opportunities, with each one being apparently larger than the prior. So that's kind of how I'm seeing it. Can you talk to us about that dynamic of using credit cycles and whether they are indeed, in your estimation, steerable by central bank policy in the ways they want?
They're clearly not. And the way the crowding out that happens from what you very elegantly describe is productivity. So if you look at the productivity for all of the major nations in the world, if you look at the 1980s, the 1990s, and early zeros, you had nice, steady productivity growth of 3 to 5 to 6% a year. Since the inaction of the suspension of the business cycle and replacing it by credit cycle, you have had zero growth. And why is that? That's pretty simple. Because when you move from a game of being a productive company, a productive person, towards one which I call a person of rentier, a person who is just increasing capital values instead of creating fundamental value in society, you crowd out the ability. And when you then take interest rate to zero, you take away all of the discipline there is involved in being a business person. In other words, the downside becomes non-existent to some extent because there will always be support. And so you create both the incentive structure, but most importantly, our society, both the U.S. but also the rest of the world, have become a massive non-productive society, which is really about buyback programs for companies, lack of investment in research and development. And the problem with that is that as we stand in 2018 on the brink to 2019 with everything being equal, some more Cold War, trade war, which is going to decrease the amount of volumes. You have America First versus 2025 China, both of them plans which is really about self-sufficiency inside your own country. Looking, not out of the window, but looking into the bathroom pretty much instead. And all of this means that at a time where we most need productivity to work through the system, we have no investment in it. And what we also know is that productivity comes from one thing only, really. It comes from education, education, and education. And what is the one thing in America where people don't have equal access to? It is education, right? We are underfunding the public service system in terms of schools, in terms of basic research. We all want it to be in the private sphere because it's not on behalf of the taxpayer. But hang on a minute. Look at the history of innovation. Look at the history of productivity. All of the great leaps we've done in that respect has been done as a public experiment. Take the internet that was born out of the CERN in school, which is a public thing. The genome mapping, probably the second one that comes to mind in terms of the global reach in terms of productivity. So Chris, the ultimate prize for the suspension of the credit cycle is where we are today, where we are non-productive people, and we are just interested in improving our world by a 1% a year marginal change relatively to, a world where we want to be better, we want to be more productive, we want to be more educated, we want to be better citizens of the world and the like. We have exactly the opposite of that as a prize, because a business cycle is what cleans the system. If you don't have a business cycle to clean out the weak players, you're going to have only weak players ultimately.
This is a fantastic topic to discuss, because this is going right to the heart of what I've been thinking for a long time here. And you just reminded me that I hope I have the numbers right, but I read a report recently that the BIS noted that in 2016, I think the data comes from, that 12% of all companies in the OECD countries, if I have my numbers right, were zombies, meaning their operating earnings were insufficient to cover debt service payments. This is the Japanification, right? We've all turned Japanese, I guess, that spreading of these zombie companies. To me, that feels tied right into this whole idea that the essence of a zombie company, it's fundamentally a non-productive company, and they're kept alive because the credit cycle is still in expansion mode. But when, not if, but when the credit cycle comes to an end, and they always do, the tiers are going to be pretty powerful in this case, right? Because I would assume at least 12% of companies are now exposed to, and I assume the number's even higher now than 2016. That means they are all exposed to just being wiped out.
Trace, every 25 basis point, there's going to be an additional 10-20% added to your tally. I mean, think about the world, and that's also the problem with the credit side. It's okay to go from a global interest rate on average of 6% to zero. Well, what are you going to do at zero? Are you going to go to -3? Of course, it's theoretically possible, but at -3, a lot of things happen, among them, of course, being that cash doesn't work. So So the fact of the matter here is that we are in a corner, and from that corner, I think there's a positive solution, which is to refocus on research and development, basic research and education. I think that's the positive measure. Or there is the negative measures that if we continue to pretend that this is going to be okay, and this is like the IMF, the World Bank, the ECB, Federal Reserve have all declared that we are past the Lehman crisis. Listen, we haven't even gone out. We haven't even started on the Lehman crisis yet, because, as you said, we just pretty much pretended and extended by activating a credit cycle instead of a productivity cycle. And I think if I was to forecast the next 2 to 3 years, I think two or three significant things is changing. One is whoever is productive as a country, as a company, as a person will survive, and that will be the only survivors. Number two, there will be a total close down of all this testosterone-driven politics in the world. The Donald Trumps, the Erdogans or whatever. I think the world is fed up. I think there's going to be a huge political swing towards women and non-testosterone-driven decision-making. And I think number three, environment is going to be a massive issue. Next year, we see the introduction of the maritime sector having this sulfur contents reduced to 0.5% instead of much higher, and burning bunker oil. Everyone in the world, except the one in the leadership, in the ones that sits on the social media, they want the world to change, Chris. I think that's the positive news here, because you cannot get out of this crisis by continuing as if. So I love people when they tell me the dollar is going to be 25% stronger. I go, fine, but how does the world look with a 25% stronger dollar? That's a world which is a total recession and is going under, right?
Well, especially with roughly $4 trillion of emerging market debt denominated in dollars, I think you have a multi-trillion-dollar wipeout if that happens.
Exactly. So what's going to stop the strong dollar is the strong dollar. I mean, and that's always been the case. We fail to remember the story. And the same, actually, I stole that sort of rhythm of words from oil. In the oil market, you always say, what's going to stop the oil is going to be oil, because ultimately oil gets too expensive to go on. And it's same as you say, because we're so dependent on dollar funding in the emerging market, but also in the U.S. Don't forget, U.S. corporations are more leveraged today than they were before the crisis, because they're using all these financial shenanigans of buying back their own stocks, and very often in the process, despite buying back, diluting the investors.
Well, this is why I really fault the central banks, because they are supposed to be the adults in the room. They're supposed to take the punch bowl away. They're supposed to understand these things. I can't fault the CFO who says, listen, if I can borrow at 1% and retire stock that's got a dividend yield of 3%, do that. But across the universe, if they're all doing that, then we get into the issues you talked about.
I think you can, Chris. You have to blame the CEOs.
Okay.
The monopolies of the 20s and 30s was big oil and then the Morgans and the Rockefellers, right? But they were part of the fabric of society. They built, endowments to business school and schools. They built housing for the employees, whatever. They are zero, and literally zero filtering of the profit from the corporate sector into the employees and custody of the disposable income. Someone in the world needs to protect the disposable income of the employees. It certainly hasn't been the corporation. I think that we can put and fail on them, because ultimately in a game of less and less people who are at the high end of salary and the way the labor market and the sophistication of the world. What you need today is invest in your employees and in people and in education of your employees, and to support whoever works for you. So I think from that perspective, I think we totally lost the moral compass that it was initiated, and the catalyst was the central bank. I wholeheartedly agree with you. But I think the corporate business getting away was because it's legal. Chris, because a guy who, done nothing as a CEO, he has a contract that gets him paid $150 million, doesn't mean it's fair. It doesn't mean it's moral. It means it's legally, unattainable, and it's what it is. But it doesn't make it right, Chris. And I think the accountability of what we do and how we do it, that is also lost in this process. That has also been crowded out. And when I travel the world, that is the biggest problem. Governance. Governance has disappeared.
I totally agree. And I love this idea that you think that we sort of hit a nadir, a low point of this abrogation of the social contract, that we're done with the testosterone-driven politics. And I hope we are, because if we continue down that path, I see war at the end of that. And that could be extraordinarily unpleasant. But I'm thinking now, you remind me of that famous saying by Charlie Munger, who said, you show me the incentive, I'll show you the outcome. The central banks have incentivized this particular behavior set that we're seeing. I'm not saying they're 100% responsible. I agree CEOs have their own moral compasses that should have been guiding them that seem to have gone adrift. But the central banks really, with their credit cycles, they did a lot of things that weren't just about monetary policy. They were engineering with social policy and political policy because of the incentive structures they created. They should have known better. That's my main critique for them.
No, and they made the whole world unaccountable by making interest rate go to zero. I think the worst thing they've done is taking rates very close to zero, because in the world of zero interest rate, nothing works, and certainly not discipline, not accountability.
Absolutely. So let's talk about number 2 of your Horseman, the price of money. I guess we have to start at the headwaters of the Nile. Where do you see U.S. Treasury rates going from here?
So as I alluded to before, I think Powell is actually a very good central banker because he's not an economist, which is always a good start. and I think he's very pragmatic. I simply think he's going to hike until the market stops. And as I said before, that is in market terms, 5 to 10% below the present low, which means we are 1-2 interest rate hikes away from Fed going on pause. So I think in Treasury terms, I think Treasury is becoming into buying opportunity, and it will be devalue if, as I expect, they go ahead in December, simply because interest rate cannot go higher, Chris. I mean, the whole conversation we had today is about the fact that if you have a smaller credit cake and the cake of the pieces in the credit cake getting more expensive, something needs to give, and that, of course, is the trajectory of the price of the cake that needs to get cheaper. If you get less cake, you've got to pay a less price. So I think we are 1, if not 2, hikes away from Federal Reserve stopping, because then the consequence on the market will be felt. And what was interesting about Friday's close was that we made new lows in 10 years and 30 years, right? So if you look at interest rate, they're just continuing to go higher in a market of right now flat sidelined activity. But the fact on that, cost of capital continues to be impacted by the Four Horsemen.
Well, now let's turn to a piece that just catches my eye on a daily basis. LIBOR, it's making new fresh cycle highs right here as we're talking, more than double where it was last year at this time. It seems important, especially given the zombie company, as I talked about. How important is LIBOR, or is that an irrelevant benchmark these days?
It is in the U.S. because because financing is either equity or bond markets. So 2-year rates and LIBOR is really following each other. But I agree with you, Chris. I mean, if you look at the steepness of the rise in 2 and 5 years and LIBOR this year, it's amazing. I mean, it's equivalent 10 years. It's about 80 basis points. I mean, even in the strongest economic momentums, the magnitude of the move in basis point is up there with some of the biggest. I mean, this is one of the harshest, most steep rises we've seen in the cost of capital. But I think it's just a function of that the U.S. has been delayed through all this action from the Trump cabinet in terms of tax cuts and other things. That's sort of hidden inside the inevitable, which was that again the Four Horsemen were all negative gravity on all of this in terms of higher price, higher energy, and less of it to play with for the world. So I think it's a natural consequence. I'm not entirely surprised, but to be honest, I'm surprised that Federal Reserve is totally ignoring the one-off impact of repatriation of capital. And Chris, we talk about more than $4 trillion that's taken from the European banking accounts into the onshore U.S. banking system. Again, that should be something good, but when reality means that the U.S. credit system is overflowed with domestic credit that no one can use, which means that no one's going to make demands on lending, which means velocity of money is going down, which means that the economic activity again continues to just be pretty much based on buybacks and manipulation of balance sheets.
And those buybacks, by the way, will, I think, go down in history as one of the dumbest corporate moves again. But corporate buybacks tends
especially when you leverage them, as some of them have. I mean, when you are borrowing money to do it at the bottom of the interest rate cycle, that makes no sense.
Oh, I know. It's just going to be, again, the dumbest of the dumb moves out there when we should have been investing in the productivity number 4. But looking at this price of money still, this, one of the things that confuses me here is I'm watching junk bond indexes. I like to watch from the outside in. I watch the weaker elements first to see if it's going to progress towards the core. You just mentioned, emerging markets have been falling for a long time. The rest of the world's weak. It's finally made its way seemingly to the core, the United States equity markets. But I'm confused here, Steen, looking at JNK, HYG, other sort of junk bond indices. They seem complacent here. I don't get it.
They're not complacent, but they're a function of what I just told you. If you take $4 trillion in euro deposit dollars and transmit it into and move it into the U.S. onshore banking system, what's going to happen? Everyone's going to look for the excess return. So what is happening is that all the junk bonds, all of the credit spreads is artificially fueled by this new money that came into the U.S. onshore banking system during the 2018. 1 trillion of them went into buybacks of stocks, but another 2 to 3 trillion is sitting as slush fund in bank accounts, and some people want to invest it in junk bonds and others. So I think counterintuitive. Actually, I think these sort of JNK and the others will be slower moving everything else, because actually companies pay an earlier price than the cash deposit and the free cash flow that has been available to the onshore banking system. And look at JP Morgan, look at all the major banks. They're not lending out any money. There's no one that wants to lend money. There's plenty of money in the system. And that, of course, is keeping the credit down. And you will see that, Chris, and you see reactions as soon as you see the slowdown in U.S. growth. And I think, come Q1, Q2, you will see significantly slower growth. And then all of a sudden you will have an explosion where you see the spread go up by not one factor, but probably 2 to 3 factors, because then you're recoupling back to the economics gravity of the Four Horsemen. But this inflow of capital has totally distorted everything you and I grew up watching and using at early alert systems. So I think any factor and no disrespect meant, but I don't think any historic use of credit spreads and whatever can be used in the U.S. as long as this slush money is still filtering through the banking system in the U.S. I think the stock market, as an indication, is starting to unwind, and I think as we come into the end of the year and into early next year, it's totally disappeared. And then you see the natural move where all of a sudden you get 2 standard or 3 standard EAVs move to the upside. So I'm like you, Chris. I'm waiting to see when something breaks, and then I'm going to go on those trades and be short credit vis-a-vis the U.S. government.
Well, if my trusty triple C credit spreads are no longer a reliable indicator, and that makes my stomach clench a little because I love having early indicators, what is a useful indicator here besides, or do we just watch and wait?
No, you watch the M2 global over global growth, the one I tried to explain earlier. That is your new credit spread indicator, because that indicates to you whether the world is in an expanding credit mode or just contracting. Of course, the issue you have right now is that China is actually expanding again. China is so much in a hole that they have to fill this hole up. And to go to a positive drift, they need to do a lot of stuff. So I would expect, and one of the calls we made right now is and I made over the last 6 months, is to sell U.S. equity exposure at 3 standard deviation expensive for all the reasons we discussed, and buying something like emerging market, in particular emerging market China, which is 2 to 3 standard deviation cheap. In the process as a portfolio construction, you are playing mean reversion, which is non-correlated to momentum trading overall, which most of the strategies are built on, and then you increase your potential upside and you reduce the volatility of the portfolio. So I think it's a very, very easy game to do. I'm not saying sell all of the U.S. exposure, but sell all of the froth that you were given in 18 and 17, so go back to where you were in 2016. So I think it offers us a lot of opportunity to play the game, but what will be incoming is more credit expansion, bigger credit cake from China. It will take longer than the market wants, which is going to create a slowdown and a nervousness all the way through the end of the year into early next year, in particular, of course, if the midterm means we're going to have a split Congress. If the House and the Senate is going to be split, then, I think Trump will be on his re-election campaign. It seems there's only one thing that really works for him, and that's being anti-China.
So, Steen, how would I track this M2 growth over GDP? Where would I find that data?
So M2 is, go to the net. There is a huge amount of M2 numbers. I'm very willing to people can follow from my economist Christopher Dempik at Saxo's research. We can put a link into the to this podcast.
Great.
That's something we do extensively, but that there is a huge number. I'll be more than willing and get people can get Christopher's email to follow both the credit cake, which is the change of change, and the actual change, as you alluded to for your listeners, if we can facilitate that, Chris.
That would be great. I personally would love to have that, and even if I got that, I might be able to share it with a few of the people on my end who care. That would be just fantastic. So, well, let's talk about China for a bit. So a lot depends on this. Last time we talked, China's credit impulse was negative, but now you're saying it's turned around. First question, is it too little too late, or are they doing enough here?
It's never too little in the case of China, because that's the way
Right.
I think you said you led with a question before on. But the thing is that China is in a deeper hole than they are actually admitting. So in other words, growth in China right now is significantly lower than what is reported.
Right.
So the problem is that when they start to engineer an easing of monetary policy, which have been very aggressive in terms of cutting rates and cutting the triple R, as we talked about, but now they're also doing, opening up of the markets and other things. But I will remain very, very focused on China ramping up. So they are asynchronic in terms of the U.S., and funny enough, every time they are asynchronic in terms of boosting, they also means the peak in the dollar is very close in sight, which is an interesting leading indicator as well. But in terms of China, they will be there, but it will take longer this time than it did in 7 and 8. Don't forget the stock market in the U.S. bottomed in March 2009, but all the way through 2008, China did the biggest fiscal expanding by any nation ever in the history of monetary history. So China has always, for some reason, been asynchronic, the residual of what the rest of the world has been doing. When the rest of the world has been peaking, China has been in a hole, and that's what we see similar here. And China needs this. They cannot afford for things to fail now, so they're going to go full in. I can guarantee you that.
Well, I agree that they want to do that. I'm wondering if they can, because, the 08-09, they had a lot of headroom. I'm looking at a chart here that shows that China's current account deficit is now, for the first time on this chart, at least, it's in deficit. So it seems like, China, obviously a very positive export balance country, but still they have a negative current account deficit. Does that factor in here?
Yeah, absolutely. And that makes it slower. So in other words, in 2008, 2009, one credit CNY would create one CNY growth. Now you need 2.5 CNY input to get one growth. So it's simply 1 to 3 slower in terms of what happens. So absolutely. And as you rightly say, they had a current account in Q1 for the first time in decades, and the overall position is weaker. But at the same time, they have more people in the middle class. They have a stronger pull from technology. They have a higher propensity to use productivity and the like. So the American version of China is always one where China is a backward country that is just produce cheap stuff. But they have the world's 2 strongest supercomputers, by the way, run on 2 chips made in China. First, quantum telecom communication was in. They have the greatest amount of users on the internet. Blah blah blah. I mean, I'm not the ambassador for China here, but the simplistic sort of message of China not being able to ramp up stuff. And then in the process also, don't forget, in 2008, 2009, China was still mainly an export economy. Now they take more from domestic consumer service spend than they do from export. So the whole setup is constantly changing. I think to some extent, as much as you and I love the charts, what it does not explain when we look at the chart is what is the different premises and what is the different execution of strategy that happens in the different time loops. I think you should be very careful ignoring those.
Yeah, I always have a huge grain of salt whenever I'm trying to understand or explain China, because it operates very differently in ways that I don't fully understand. So it seems they have more command and control and more ability to pull levers. And as well, when I was talking with somebody last year who's fairly high up in the Chinese leadership, and his understanding of resources, energy, economics, science, it was just astonishing. And really one of the things that he noted to me privately was that in China, they don't have a lot of lawyers trying to run the run the ship, as it were, meaning that the United States is really heavily stocked with very non-technically oriented political leadership. And China's got a lot of technical capabilities, and they get things. So on your last horseman here, to get to it, energy. This is something, obviously, that I spend a lot of time looking at. China is now the largest oil importer in the world, and that's going to grow. They are past peak oil by their own admission out of the Beijing Petroleum Institute. So they're going to be importing more and more. Looking at that, energy seems to be, to me, to be one of the key things that's really going to be driving the next, say, 5 years of this discussion. I don't see a lot of focus on that in the United States. We're still waving our little foam finger around saying we're number one. We got a lot of shale oil. I think this is a bigger deal than most people are understanding. How is it that you came to put energy in your Four Horsemen model? And do you have any supply concerns as part of that?
So the reason it's in there is that everything you've done today, Chris, has electricity in it, which means that you are, whether you want or not, you are a victim of the flux of energy prices. And the flux of energy prices over the course of last year has meant that you're paying 25% more as an end user, which is a direct tax on your consumption. That's the number one reason. The second is that in terms of inflation, there really is only one driver of inflation in the world, at least top-line inflation, and that is the year-over-year change in energy. So by using as an input the price of energy to estimate or guesstimate, in my case, the consumption tax, I also get an early sign of what happened to the inflation rate. And then if you look at a chart of year-over-year changes to the oil prices and the CPI in the U.S., it's correlated 98%. So, people can talk about wage growth, they can talk about all sorts of components. End of the day, it's really just energy. And it makes perfect sense because, again, everything you do, Chris, today will have electricity consumption in it. And through that, of course, oil consumption, coal consumption, whatever. The other thing I want to mention on the supply side, I think two things is happening in the world. I think peak demand, to me, you're much better than this than I am, Chris, but I'm really more concerned about peak demand of oil. And I think what's going to drive peak demand of oil is that in China, for instance, the party secretary of the local city, the local government, they all have two goals now to fulfill. One is the GDP growth. The second one is reduction of pollution. If you look at the maritime world, they are introducing a sulfur tax now, where all the ships in the world have to have either what is called a scrubber, or they have to burn more fuel, clean fuel. Everywhere I go in the world, I was in South Africa last week. A businessman came up to me. He was the biggest producer of diesel diesel generators in Africa. Of course, a vast business, a big business in Africa because the electricity grid is not entirely built out. He was asking the same question: do I need to be the best of the worst? In a sense, of course, diesel being very pollutive. So I think we're going to have in the world probably even a global transport tax. I mean, why is it that to make 2 cents you send things to Vietnam and China and ship it back on very polluted ships and the likes back into the U.S. when it could be done, locally or through 3Ds and others? We know why, you and I, Chris, because we haven't done any R&D and we're not investing in the factory because we'd rather just have cheap labor. But to upgrade the world and to go to a higher productivity, I think a big chunk of that, Chris, is going to be on the supply side of the energy is going to be less relevant than the demand. I think every single process there is, any business that survives in the next 10 years will have to deem themselves to be best in class, even the best of the worst in terms of their energy consumption. So I find that interesting. And just also the week before I was in the Middle East, it's a big theme in the Middle East now. They do realize that it's probably more likely that because we have discoveries of oil fields, there was just one outside Bahrain, which is deemed to be almost as big as Saudi. So I don't think it's going to be peak demand. I actually think peak supply. I think it's going to be peak demand that is first up. But Chris, I have to say you are the expert here, not me.
Well, I keep hearing about the peak demand, but I just follow the charts, and we're up over 100 million barrels per day of liquid fuel consumption. That's a first. That just happened a quarter ago. And of course, we're still seeing 85 to 90 million new internal combustion engine net vehicles added to the landscape. And yes, electric vehicles are coming along, but on a percentage basis, they're swamped by the fact that the rest of the world is still growing and the emerging markets, people want transportation and cars and scooters and things like that often make up that mix. So just following where it is right now, that's what I'm seeing. I'm a little concerned on the supply side, for me, because we have 4 missing years of upstream oil and gas investment. About $1.5 trillion didn't happen. And that, of course, it's like farming, but with a 5-year lag instead of a 1-year lag. That creates a supply hole somewhere out there in the 20, 21, 22 zone. Just looking at that, the demand side it's shifting, but this is a super tanker, to put that metaphor in. It takes a long time to turn that wheel. Yep.
No, I agree, and in terms of sparse capacity, we're under 5% global round. But so I'm not objecting to we could see $120 oil. What I'm really saying, at the margin, the winning businesses of the world need to be compliant with. I agree. Being reducive. So I think, and as marginal changes, I think everything in the world is based on marginal changes. So I think I agree with your the next year, maybe even 2, but I think this marginal change, it will be a massive momentum. Chris, I go to 30 countries, everywhere they want to talk about environment, and I'm not exactly an environmental expert, as you very well know. So this is part of the political fabric now, but it's very much, and more importantly, it is really what the consumers demand. So I think, let's agree that momentum is on your side in the short term, but I firmly believe the next trend in the world is going to be consumers demanding to be part of a better world in terms of the pollution.
I absolutely agree, and this comes full circle, and where we align perfectly is a statement you said earlier, is that the productive are going to survive, the rest are going to have difficulty, right?
Yes.
So productivity, one big portion of that is energy efficiency, and so a big critique I have in my country, we still build houses that are fundamentally not energy efficient, like poor insulation, all that stuff. And buildings, commercial buildings in particular, as you go into a more energy expensive world, all of a sudden, I think that's the big shift, is people are going to say, wait a minute, I can rent a building that has half the energy input costs of another one. I want that one, not this one. That's going to be true across the entire transportation landscape. So companies that are fundamentally inefficient, that have 60,000 mile supply chains because they haven't thought it through, and suddenly their transportation costs go up because of these factors, they're going to have a tough time relative to the others that have seen this coming.
That's exactly it. That's really, Chris. And I can tell you, here in Denmark, where I live, I'm being forced by my local borough to go into having all kinds of alternative energy. I'm not allowed to do fossil burning anymore.
Yes, and that
by
trend,
regulation.
Big trends coming forward, and not a minute too soon either, by the way. I think we're a little late to this game, but it'll happen, and I'm looking at that. Over the near term, I still have concerns about supply going forward. We'll see, because that Bahrain discovery you talked about is actually going to require horizontal drilling. It's unclear if they have the technology and the expertise and the infrastructure there to do that. It could be a big thing, but we'll have to see after they get a few actual wells drilled. So I'm looking at that one, but I got one eye half open. With that, Steen, we're out of time for today. We could talk to you forever. Thank you so much for your time today. Tell people how they can follow you and your excellent work more closely, please.
Yeah, so I represent Saxo Bank as an economist and chief investment officer. So feel free to go to saxo.com and saxobank.com and find the research. There are plenty of research. And I think as a courtesy, because we talked a lot about credit cakes and monetary aggregates, I will shoot you a link to directly to these research, so your listener can follow it, Chris.
Thank you so much. All right. Well, Steen, thank you so much, and I can't wait for our next conversation.
Thank you for having me, Chris.